Should I pay off my debt before starting investment? This is a question I received recently, and an investor approached me saying they've got so much debt, they're not sure whether to start investing or to start paying their debt first before they start their investment journey. You see, so every investor or every entrepreneur has a different aims and objectives. In this video, I'm going to share with you what my personal experiences are and how I've been able to help people kind of prioritize what to look for when they're investing in their property. This advice is purely based on my experience. I'm not qualified to advise you on a debt. I'm not a debt management agent. It's purely experience that I have executed for me and the people I work with. But before we get going, if you like this video or any of my videos, don't forget to hit the like button below, subscribe to my channel for more amazing videos. So subscribing to our channel really help because it help the algorithm to push our videos up there. And we've also noticed 70% of the people that are watching our videos are not really pressing on that like button. So I really appreciate if you can press on that like button and also subscribe to the channel, because if you subscribe to the channel, there's so many benefits that you get notification once we've got new videos in the channel. So let's get to it. So you see, so in order for you to start investing, obviously you need to kind of be in a better position in terms of your debt ratio, and it's not something that people can easily overcome. But what I will try to do in this video is to actually show you step by step on what you need to do in order to start your investment journey, regardless what your financial situation is. So I advise you to watch until the end, because there's so much golden nugget in order for you to start your investment. What I normally look at for people that are in a debt, and when I call talking about debt here, by the way, I'm not talking about a good debt, which I will talk to you about in a minute. I'm talking about bad debt. What is a bad debt? A bad debt is anything that you buy that doesn't bring you residual income. It could be maybe trainers, a shirt, a jean, or maybe paying for expensive holidays, giving gifts away that don't really bring you any residual income, and then obviously it's literally borrowing the money to actually buy these items. That's what causes it to become a bad debt. So what is a good debt? A good debt is any debt you take or you borrow and you use that debt to invest in something that can bring you residual income. This could be anywhere from investing in various businesses that would give you recurring income. It could be investing in an asset that can bring you residual income, like properties, for example. It could be assets such as properties, because properties would not just go up in value, and it also bring you passive income as well. So before you start looking at investing, look at your debt first, so know where you are, whether they are bad debt or good debt. You know what they are now. You go and look at it and understand what they are in terms of your own expenses you've made. So before we get to that, you know, in order for you to be able to work out how you can pay your debt, what I normally advise the people I work with to do is basically, let's look at the budget. So how much are we spending our money on? Where are we spending our money? What are we doing with the money that we currently have? Are we spending it in something that don't really add value to us? Are we just on subscriptions that don't really bring anything to us? Or are we actually spending more than what we are earning? So what we do, basically, we determine that first. Once we know where we're spending our money, and then we create something that we call budget. So basically we budget ourselves. I tend to push the people I work with, including myself actually, to kind of live on 70% of whatever you make. You know, if you're making, suppose you're making £1,000 and you want to live on this £700, and then obviously then you save the £300. That may be difficult for some other people, but I'd rather to feel an uncomfortable life right now, feel comfortable when I'm in my mid-50s and 60s, instead of living all my nice amazing life here and the worst to the end of my life when I'm not able to do stuff. I then tend to struggle to meet my finances. So I advise you to kind of, you know, live on 70 to about 80% of your income, and then what you do, then basically you store the rest. So that's the first thing we look at, your budget. You know, we stick to that budget, and obviously whatever extra amount we make, what we do, basically we pay ourselves first. What do I mean by that? Suppose you're working for someone. What we tend to do, basically, we find out when you're getting paid, and we set a standing order. Okay, a standing order from the account you're getting paid to another account, and that account then would be our storage account. That's where we store the money, that's where we save the money in order to literally only use what we've left in our day-to-day current account. So that's what we do. Basically, we pay ourselves first, right? That direct debit or standing order goes to that account instantly. So whatever is left over is what we're going to live on. So number one thing you need to look at is about creating a budget and stick to that budget. Okay. Number two, what we do then, we look at the debt. Okay, we look at the debts that we have identified. Well, in most cases they are all bad debt. So what we then do, we look at the one that got higher interest rate. The debts that have got higher interest rate, we tend to pay those debts first. I'll give you a reason, because this higher interest rate debt kind of accumulate, like the longer it takes, the more it goes up. And especially if you're in a variable rate interest, it literally goes up every time the Bank of England increase interest rate. And if you're using credit card debt as well, if it's a credit card debt, the same thing applies. So what we tend to do, we look at the credit card debt first, or the debts that have got higher interest rate. What we do, the money that we're storing, we kind of try to pay it down. Okay, you'll be paying that down slowly. And then whilst we're doing that, we then kind of look a way how we can consolidate the debt in order for us to have one sort of expense to pay towards that debt. Whilst we're paying the higher debt and we consolidated the debt, we will then be paying that debt whilst we start looking now for rental properties, investment properties. So when we're looking at the investment properties, then we're not just going to go and buy any random investment properties. We look for properties that fit our criteria, not just our criteria, but that literally meets our financial needs. What do I mean by that is, because we know we're paying lots of debt currently because we've got bad debt, what we look for properties that can generate us a bit more higher rents than the normal rent. Let me explain this to you. Suppose we're incurring about 7% interest on our debt, okay, that we're paying. These are the bad debt. So what we tend to do, we look for properties that generate us at least minimum of 10% return of our investment. So what we then do, we know we're paying that debt 7% every single month, and then 7% every single month. So what we now do, we know we've got that property that we're looking to invest in that is generating us 10% return of investment every single month. So if you minus 10 from 7, you've got at least 3% sitting somewhere. So you're not knowing, you're knowing now is basically you're looking for properties that will make you enough money to be able to pay your existing debt, and at the same time also be able to pay for whatever that mortgage interest rate is. So this is vitally important. So hence we go out there, we do not just look for random properties, or we don't just look for properties that are very kind of easy to get and where you cannot make that money. So we look for properties that we know we're going to be making anywhere between 10 to 15%. So when we look at this sort of properties, it might be a normal buy-to-let property, it might be a normal apartment, things like that. But what we do, we look for properties that we can add value to. Suppose we buy in this property, we now know, because we've got high debt and we've been incurring debt once we bought this property, we look at the property in a different way. We said, okay, if we buy this property, are we able to convert this property into a HMO property? Right? Or are we going to convert this property into a mixed-use property? Are we going to convert this property into 2 apartments? Or are we going to have a loft conversion? Stuff like that. So we try to find a way to manipulate what we've got in order to give us higher return on our investment, in order to be able to start paying our debt and at the same time building our property portfolio. Let's now say, suppose we've got this property, it's a 3-bedroom house and it's a 2 reception room, and we're then able to convert that property into a HMO property. For example, we're able to convert it into, say, 5-bedroom HMO property. So then, instead of renting that property for about £900, if we're able to convert that property into a HMO, we will rent those property in a room-by-room basis. Suppose we rent that property, each room, for about £500 per calendar month. That will then generate us about £2,500 a month. Taking all our expenses out, we may be making about 1,000 or maybe 1,200, versus having a normal buy-to-let property that we would have rented for £1,000 and we would have only made about 350 to about £400 per calendar month. That's what we look at in order to ensure that we are investing whilst we're paying our bad debt. So once we start getting that going, obviously we will buy in the property, do whatever we need to do in that property. What we then do, the remaining proceed we make from that property. Suppose then we're making about £2,500 and we're making about £1,200 net profit. Some of that money would go towards helping paying the bad debt, and some of that money we're not going to touch it. We're not going on holiday, we're not going on buying expensive stuff. We're going to store that money. Hopefully we would have remortgaged the property at a higher rate, forced that value, and we were able to pull some of that money out. So what we then do, we put those monies together, and guess what, we go back in the market to look for exact same property or even better property in a way that we can force the value, right? Do the same thing again, reinvest that money, have our second HMO, and then at that point we'll be making net profit about £2,400. We're getting £2,400, and then hopefully then we would have done that property up, right, and remortgage that property up. Value has gone up again. Guess what, we remortgage, pull the money out, we go again, buy another house. So that's how you can reinvest and reinvest. By the time you think about it, it would have a snowball effect from 1,200 to 2,400 to 3,600. So now you can see then how your income would start to grow. Once your income start growing and your credit score start improving as a result, right? What you could do, you could by then maybe you've been in the second or third year, maybe say second year, and you would have had capital appreciation at the same time as well. So what you could then do, you can go and remortgage those properties, or maybe one of those properties, use some of that proceed to pay off all your bad debt. I'm talking about the debt that you've incurred before you start investing. And then once you've paid all those bad debt, all the debts now you've got are not bad debt. These are debts that are being looked after by the tenants you bring in these properties to actually pay for the debt you've incurred. So by that time then basically you would have become bad debt free, and you may have also become financially free. And then if you don't like what you're doing at work, you can then quit your work and then obviously start investing in property full time. I really hope this video has been helpful, and if this video has been helpful, hit the like button below, subscribe to my channel for more amazing videos. I look forward to sharing the next video.